like the notes that we put together for this show this week, fellas. This is Retirement Compass Radio Show with Stonebridge Wealth Systems. And I have Jeff Gove and Tim Kulhanek. I'm Jackie Selby. God's not done with you just because the HR department is. That's pretty funny. You still have to work. Even though HR might have called you and said, can we meet you in the HR office? And your manager will be there as well. Has that ever happened to any of you guys? You got the call from the HR. It says, we're going a different direction.
Do you know who our HR is?
Oh, no. Who is it? You?
His name is Scott Noctegal.
Oh, Scott? Oh, golly. But some people are getting the layoff here lately. And I was even reading the economic indicators. What, Jeff? We were talking about this before the show. The Bank of International something or another that says that if we're not all optimistic about AI investments, then the market could become bullish. Bearish, down. Right? Bear, down.
Yes.
So I think we're going to witness some job losses and so on and so forth. So
You think?
You think? That having been said, fellas, we have worked very hard, and those who are pre-retirement in the financial red zone, whatever you want to call them, or those who have just dropped into retirement, I mean, there still is a whole lot of money in 401ks. So how do we get this whole thing started if we want to retire? And this includes deadlines, responsibilities, et cetera, et cetera. Does it all start with a meeting with someone at Stonebridge, Jeff?
Yeah, it starts with a meeting with someone, that can help you navigate the process. When you retire, it isn't as simple as, turning in your notice to HR and then moving on with the rest of your life. It's, if you're 65, getting signed up for Medicare, if you're going to go on Social Security, getting signed up for Social Security, those aren't things that happen immediately. If you have a pension, it takes a lot of times over 60 days to get that pension started. So you have to have a plan to make sure everything is in place when you're ready to retire. The other thing, if you're not 65, what are you going to do for health insurance between, if you're 62 to 65, until you can go on Medicare? There's a lot of boxes to check. And if you miss one, it could cost you a lot of money. You might have to go a couple months without having a paycheck if you didn't get everything done. So you got to make sure you have a plan in place.
Mm-hmm. It starts here with a quick phone call, 866-295-5146. You can call Stonebridge. You can check them out online, stonebridgeiwm.com, stonebridgeiwm.com, or, again, 866-295-5146. But they want to get you to where you want to go in your retirement. And so, Tim, how do you talk to people about what it is they want to do? Is that your opening conversation? What do you want to do in retirement?
It should be, because ultimately that's what people care about, and that's what they want to know is, like, three main questions. When can I retire? Well, if I retire at that age, okay, will my money last as long as I need it to? And then what if something were to happen to me? Would my family be okay? Would my spouse be okay? And, for us, for Jeff and I and our team of experienced advisors, like, the exciting part is getting to solve problems, right? Because to us, it's kind of like solving a puzzle. And the good news for the folks that are listening and the folks that work with us is, we've solved. It's almost like if you're doing the puzzle for the 100th time, you kind of have a pretty good idea. You can just look at the shape of the piece and you know where it goes. You don't have to really study the box and the picture on the box that much. So you can look for clues. But that's probably not that exciting for most of the people that are listening, is like determining the break-even point on Social Security, determining what impact the One Big Beautiful Bill Act is going to have on their decision to do a Roth conversion, whether or not they're going to end up in the 22 or 24% bracket, if they're going to be phased out of some of their additional 65-plus deduction because it's going to push their modified adjusted gross income above $150,000, which means instead of paying at 22%, that bracket doesn't really exist for married couples or for anybody that's 65-plus because that's where the phase-outs start. So you're actually paying, depending on whether you're married filing jointly or single filer, somewhere between 23 and 25%. That stuff is really interesting to us. We want to know, like, the why behind it.
Sure.
But what people care about is, what can I do with this money? What is this? What type of lifestyle does this afford me? And so we don't use usually the term budget. We might ask somebody, do you have a budget? we know that probably, I don't know, Jeff, what do you think? 7 out of 10 times, 8 out of 10 times, people don't have budgets.
Yeah,
right.
right.
But okay, well, let's not worry that much. Let's not get wrapped around the axle about what you can afford to spend, because that's how people like that. That's very restrictive. Something that's more freeing, and I think more of a abundance mentality would be, well, let's create a spending plan. What if we created an environment where you were able to confidently spend $10,000, $12,000, $15,000? I mean, and it goes up from there too, a month in retirement. Doesn't mean you have to spend that. Some people might hear those numbers and be like, well, it's way more than I need. Well, okay. But if our plan that we design is going to work at 12,000 and you only need 7 or you only need 5, guess what? That just means you have more discretion to use your money, to be more generous, to help family out, to help charitable organizations out. The people, places, organizations, and entities you love and care about are going to flourish more, and it's going to be because you're going to have the opportunity to be, more generous and philanthropic. So, yes, it starts with what you want to do. Let's create that spending plan. But let's make it a reality. But let's encourage people to spend their money and actually go and do, because, like we talk about this a lot. Material things don't bring you that much happiness. Like, they just don't. You could buy a bigger house or a fancier car, and maybe for maybe a month or two, that's like really cool. But after that, it's just your house. It's just your car. You don't get in it, and every 6 months later, you're like, all right. And it's like, oh, I'm just getting in my car, But experiential purchases do actually have a lasting impact, because the experience triggers something in your brain. It starts with the amygdala, and eventually it gets kind of locked into the hippocampus, where it osmoses into your brain. And it's something that time seems to slow down when you have those more, I guess we could call them almost like high impact. It usually happens when you experience either excitement, fear, danger, or abundant joy, where time kind of slows down and your brain essentially records more frames per second. And so you remember those experiences a whole lot more. That's what we want to try to push people towards. Isn't just buying more stuff. That's great. If you want to, we'll help facilitate that as best we can. But tell us what you actually want to do in retirement. That's what I care about.
Well,
Sure.
the other thing that I think is important when it comes to spending, and Tim, I think you'd agree, a lot of people come in and they're like, well, my expenses are going to go down when I retire. We bring in probably $6,000 a month right now net, but our expenses are probably $1,500 a month. That's about what we spend. And then we have to back solve that of, okay, you have $5,000 or $6,000 a month coming in. You're saying you're living on $1,500. Where is the rest going?
All the time.
And yeah, because they don't have a
Really?
budget. So then we back solve that and see, okay, all of your $5,000 or $6,000 a month is getting spent. Yeah. Your expenses are not going to go down. You might spend it on different things.
Yeah.
Like if you're commuting, maybe you don't spend it on gas, but maybe you spend it on an airline ticket or whatever it is, on your grandkids. So the expenses are probably going to go up. And like Tim said, I mean, who wants to retire and go to beans and rice and sit on the couch every day and just be retired? That just be happy that we don't have to go to work. That's not a retirement that I want to have. I want to go do the things those bucket list things, take the grandkids on trips, hopefully way down the road, going to do things that are fun. I don't want to retire and just wither away,
Yeah.
Yeah, it's a total lifestyle redesign, and you can have that conversation with Stonebridge, 866-295-5146, 866-295-5146, and you can reach Stonebridge. Also, a very nifty tool is up and running. It's called StonebridgeTaxBill.com. So you can see your 401k money and how much it's going to be taxed. Isn't that an accurate description of what the Stonebridge Tax Bill landing page does?
It generally does. We call it your total tax burden. So
Okay.
It gives you a glimpse into the total tax burden you may have on that IRA or 401k, any pre-tax type of account that you have been socking money away for the last 20, 30 years. That's what that tool is going to tell you. It's basically going to say, hey, here's your mandatory tax bill. I can't change this. If you're in the 25% tax bracket and you got $1 million, you're going to pay $250,000 in taxes. I'm sorry, I can't change it. Here's your optional tax bill. You can follow the government's plan and pay this extra $750,000, which some people might say, well, that'd be all my money. That's not exactly how it works, because your money's going. We're assuming it's going to continue to grow. But it is possible that if you have $1 million and you only take your required distributions, and then you pay tax not only on those but all of the reinvested dollars, and then your kids pay a tax on what's left. it's very possible there could be $1 million in a tax bill over your lifetime if you have a 30-year retirement. So absolutely go to that. But then again, you have to make a decision because there's two types of people, right, Jackie? There's the folks that hear this, they go to the tax calculator, maybe they look at it. Like we know there's people going to that website.
Yes.
And they kind of play around with it, but they don't want to hit the submit button, you know? They're like, just see how much I can. Look, if you want our help, great. If you don't, that's fine. We got plenty of folks that are coming through our office, whether it's from radio, TV, the workshops we do. We're looking for people who are looking for help.
Right.
So I encourage you, just go do it. Hit the submit button. Get your tax bill calculator. A really nice gentleman named Daniel is going to call you. I'm looking at him right now. He's the kindest guy on our team, okay? He's very, very gentle. He's not going to twist your arm. He was a military guy, but he was not going to twist your arm too hard. But what's going to happen is you're going to at least have a benchmark of where you're at, and then you can make decisions. So don't be the person that just procrastinates. Take action today. Jackie, one more time, you can give him the number.
866-295-5146. 866-295-5146. Call. Talk to Stonebridge, and you said something that was really kind of scary. We can talk about that in the next segment, but your big 401k could become a huge tax burden to the children in the next generation. So let's talk a little bit more about how this could be managed or attacked in advance next on the next segment. This is the Retirement Compass Radio Show with Stonebridge, 866-295-5146, 866-295-5146. Don't leave us.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
It's such a relief to know that you can find out if you are actually ready for retirement or not. Retirement Compass Radio Show with Stonebridge. Of course, you get all the information. You get to hear the fellows talk about it right here on the radio. Stonebridge Wealth Systems is their firm, and their phone number is 866-295-5146. 866-295-5146. But now, live is StonebridgeRetirement.net. StonebridgeRetirement.net. This measures your retirement readiness, Jeff Gove.
Yes. It does. We think with the Retirement Compass, we think it's really important with radio, TV, doing workshops to educate on how to be prepared for retirement. So we've developed some different quizzes off of that Retirement Compass process.
Great.
The Retirement Readiness Quiz is just another one of those that you can go to StonebridgeRetirement.net, answer some questions, and it'll tell you how prepared you are for retirement. So I'd encourage you to go there.
That's fun. And also StonebridgeLegacy.net. StonebridgeLegacy.net. What is this show, Mr. Kulhanek?
What is this show, or what does the StonebridgeLegacy.net show?
Either one.
Because this show is called The Retirement Compass with Stonebridge. Welcome, Jackie. It's an honor to have you.
Welcome on in.
So, it kind of shows what it says, right? Is we're talking about, I call it legacy done right. How do I make sure that I'm prepared to not only see my legacy play out in front of my own eyes, which is what I was talking about last segment with being willing to spend your money, but getting that license to spend, having the confidence that you can go and make that purchase. And now I'm saying purchase of the experience that we've been talking about, and not feel like, oh, that means I have to eat beans and rice for the rest of the year. But number two is, if there's money left over, there's those people out there that say, I want my last check to be written to the undertaker to bounce, But that's really tough to do because we don't know how much longevity we're going to have, and longevity risk is a multiplier, right? So it amplifies the risk of healthcare costs because there's a greater chance that you're going to have more long-term care costs. It amplifies the risk of equity risk, right? Market risk, volatility risk, because we know that the market goes through cycles, and every few years you're going to have, a bear market, or at least a market correction. Those are very common, happen once a year at least. The average intra-year decline for the S&P 500 going back to around World War II is like 14.1 or 14.2%. So let's just assume there's money left over. Are you prepared to leave a legacy or a mess? And that's a decision that you're going to have to make. Now, we can help you, guide you down that path, like we have hundreds of other clients that we've helped throughout the country, let alone not just the state of Nebraska. But there's tools and resources that can be used to try to help ensure that more of your resources go to the people, places, organizations, and entities that you care about versus the guy on the shore watching you come into the harbor of retirement, and he's got his binos, and he's looking, he can see it. He goes, oh, yeah. He's rubbing his hands. He can come on in. And there's 3 letters on his jacket. What are the 3 letters, Jeff? Do you know? Yeah.
IRS.
Oh.
That's right. He's ready for you. Again, some people say, oh, my kids will worry about that. Well, okay, that's still your money. Well, I won't know about it. That doesn't change the outcome. So what if, what if there was a way that instead of leaving that example we gave with the tax calculator, an extra $750,000 to the government, you only gave them your mandatory amount. So it's tied in to the tax bill calculator, but that's why this isn't a story or a conversation about just one thing. What you do in the tax area, if we do a great job, optimizing your tax strategy, we streamline it, we use tax loss harvesting, tax gain harvesting, qualified charitable distributions, required minimum distributions are covered. We make sure that we do that within the confines of these new rules. We take into consideration these additional standard deduction boosts, the additional amount that you can get from the SALT cap, the additional amount that you can get from, it goes on, right? We optimize everything with your tax bill, but then you have no legacy plan and you die intestate and the state gets to decide who your money goes to and it just blows up the whole thing and your family fights over it. Did we really accomplish the goal?
No.
Not at all.
I don't think that's what most people want.
It's not at all. And because you know why most people will take action? The people that will go to Stonebridge Legacy and get started on this, why do you think it is that's important to them, and important enough to them, Jeff, that they will take action? What do you think has happened in their past?
They have experience.
Yeah, that's it.
Or they might be in the middle of dealing with something, and you hope that they have time to get it done.
Yeah, exactly.
Sometimes when I talk to my family about it, you guys, like my sister, for example, I'll throw her under the bus. I'm like, well, if you don't make any changes to this IRA that you have, 401k IRA, then when you're 73, she's like, I won't live till I'm 73. It won't matter. I mean, I get things like this from my family members. I'm going to die in my sleep at 72. How do you know that? And you're going to leave our nieces with this great big, because she doesn't have children, this great big tax bill. You're going to leave them $1 million in an IRA, and by gosh, they're going to have to pay a whole lot of tax on it.
Mm-hmm.
The government hopes so.
We also hear that usually from guys when it comes to healthcare planning. Mm-hmm. I'm not going to a nursing home, right?
Right.
No one plans on going to a nursing home. I mean, who's picking out the date? This is the date I'm moving into the home. I'm sure there's a few, maybe they're excited to go use their long-term care plan, but you have to keep in mind, you're not the one making that decision. Because you're not capable of making the decision. That's why you're going.
Right. Well, thank you. Right.
Yes. And things happen. Like I've got a client right now, and like he told me one of the last times we met, he goes, Tim, I've got some advice for you. Don't get Parkinson's. Now, he's saying it a little bit in jest, but like, hey, that can happen to anybody. It just can. Anything, like we Jeff, you were just saying like, oh, I'm not going to nursing home. We all have this like voice in our head for some reason. It's this denialism that, oh, well, that happened. 60% of people, or what is it, 80% of people of a couple 65 plus, there's an 80% chance one of them will need long-term care. It's too bad for them. It's not me, right? And it's the same thing. Things happen, right? We live in a fallen world. Our bodies break down. We become frail. And so like if you could just reposition a portion of your assets from a legacy or healthcare planning perspective from where they're at now, we see this all the time. A gentleman was in recently, and he's got like $800,000 sitting in the bank in CDs, okay? And he's like, I want safety. I don't need that money. I just want it to go to my kids. I think I might gift all of it to them right now. Do you have a plan for extended healthcare needs or healthcare costs? Well, no, but if I get that out of my estate, if you get that out of your estate, you still got the $2 million in your IRAs. Oh. And to qualify for Medicaid, you have to have $4,000. So we're not going there. What's the plan for long-term care? Oh, I'll use that cash if I have to. Well, not if you gift it to your kids, you won't.
Right.
But the problem is there's a 5-year look back and it could be clawed back in and then you wouldn't qualify, but you'd have to spend the $2 million first. You see how this circular, because it's like, no, I'm telling myself I'm not going to need this. I'll do anything besides address this, like highly likely, the longer I live, the more longevity I have, highly likely that I will experience this, you know? Well, what if I could just reposition those dollars? What if it was simple as saying, okay, well, you know, the bank CD kind of works like a flip phone. It's great for my 79-year-old dad who tried a smartphone for like a week and Marilee, give me my flip phone back, you know? It makes phone calls, and that's all dad needs. But what if there was a way to get a phone that not only just made phone calls, but you could do video calls. You could go on the internet. You could do work while you're reading the paper where you used to read the paper. Like no matter what room of the house you're in, you can be getting work done, responding to text messages. There's a lot more you can do. At the end of the day, it's still a phone, right? So there's tools out there we use in the financial world that still make that call, so to speak, like the flip phone, but it just adds all kinds of other gadgets and gizmos. And it's not a whiz-bang panacea, but it's a way to elevate the utility of the asset that you're holding. So I'll give you a quick example.
Please.
A life insurance policy. There's life insurance policies where you can put the money in today, and if you don't like it, you can get it out tomorrow, okay? Now, it might take some processing for a week, but my point is it's not locked up for the rest of your life. But what those do is they all of a sudden they create an environment where, hey, if you need the money, you can get to it. Is it earning interest? Yeah, you can make it so it earns interest. So it's doing the same thing as what you were getting with your CD. The difference is it's removing that interest from your 1040. So now we're more tax efficient. Great. So now maybe we pulled $40,000 or $30,000 of ordinary income off your 1040, which means you now qualify for the full 65 plus additional standard deduction, and you qualify for more of maybe the SALT cap, whatever it might be. There's all these gives and take backs with this new bill. Okay, well, now we saved you a bunch of money. We just saved you 24% on that $30,000 that you were receiving. Well, let's take it to the next step. What if you need some sort of long-term care? Well, with the bank CD, if there's, let's say, just use $250,000, once that $250,000 is gone, you're out of that. That money's gone, right? With the life insurance that I'm talking about, it's kind of a hybrid life insurance policy. There's $250,000 in cash, but the death benefit might be $400,000. And here's the key. Because it's that smartphone approach, they let you use the other gizmos and gadgets attached to it. So you can do the Zoom call if you want to on your phone. The Zoom call in this example is they let you access your death benefit tax-free while you're living. You become the beneficiary of your own life insurance policy to pay for extended care types of costs, whether that's in-home care, assisted living. It could be in a nursing facility. Obviously, nobody wants to go there. But here's what that solved. Because the resistance that this guy has is because he doesn't want to go to the thought is awful of going to a nursing home or some sort of long-term care facility. But he really at its root, he hates the idea for paying for something that he hopes he never needs. Well, guess what? Is he paying? Is there a premium in this example, an ongoing cost? No. With this, you're just shifting the money. If you change your mind, you can get it back. Okay. If you don't change your mind and you need long-term care, you get tax-free, leveraged tax-free dollars to pay for that long-term extended care, okay? And if you die 30 years from now peacefully in your sleep, having never needed any sort of assistance, even though the statistics suggest you probably will, but if you don't, if you were right that, that's those other people, guess what happens? There's a tax-free death benefit that goes to your beneficiaries.
Tax-free is the way to be. 866-295-5146. Call Stonebridge. 866-295-5146.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Some nifty new tools from Stonebridge Wealth Systems to help you get retired. Jackie Selby back here with Jeff Gove from the Kearney office, but I know that you have clients all the way across the Midwest and all the way across the U.S. because sometimes farmers do retire and move on to sunnier climes and enjoy their lives elsewhere. So let's talk about some of your new tools, Jeff.
Yeah.
And this StonebridgeLegacy.net, I think, is going to be really helpful for our farmers because so many are going to be retiring. It's just like everyone else. It's the peak 65, and the average farmer right now is 60 years old. So in the next 20 years, they're going to be all aging out. So talk to me about the legacy planning and what goes into it for our ag clients.
Yeah, for our ag clients, there are two things that are the most important typically. Tax planning, because when you are, selling equipment that you've purchased over the years and you depreciated it all out, now you go recapture that when you sell it, or trying to determine, if I sell the ground and my basis is so low, I'm going to pay all these long-term capital gains. So that's typically an issue. The other big issue is the legacy plan. And typically it comes up, if you have a farmer that's got 3 kids, one of them is working on the farm and the other 2 are long gone and kind of doing their own thing. How do we divide this up equitably, because equal isn't necessarily fair. At the end of the day, it's whatever you want to happen. But that's why we created that legacy calculator or questionnaire. If you go there, StonebridgeLegacy.net, it's going to walk you through how prepared are you from a legacy perspective. Are there questions that you haven't answered from a tax perspective? Because if you let's say you leave a son land and a daughter an IRA, that isn't necessarily equal when you look at it from a tax perspective. So that's what that the legacy quiz will do for you, is help you to determine, how ready are you, how well are you set up with your legacy plan? Are there boxes you still need to check? It's a really, really good starting point. And then we partner with some really good attorneys across the state here that, there's some that for our ag clients that I want an attorney that specifically works with ag, that does a lot of farm plans, because sometimes it is a little bit more complicated. We have access to them. We don't have attorneys on staff. I'm not an attorney, but again, starting with the StonebridgeLegacy.net, that'll give you kind of a starting point of, what do I need to address?
Mm-hmm. This is good information, and the whole thing can be explained to you if you just hop on. It's really a cute little landing page, StonebridgeLegacy.net, and you just fill in your name. There's no obligation or anything if you do fill in the info. I know how people are like, I'm not giving out my email to anybody, but it's okay. It's not going to pepper you with stuff you don't want. It's just limited to seeing how your legacy readiness is, solidifying.
Mm-hmm.
And the whole thing, you have StonebridgeRetirement.net, StonebridgeLegacy.net. This is exciting. And of course, our StonebridgeTaxBill.com.
Yeah. And the StonebridgeTaxBill.com, if you've got money that you've accumulated in a 401k or traditional IRA, that's a great calculator. Because I think you'll be surprised if you go there, StonebridgeTaxBill.com, to see how much tax you're actually going to pay on that IRA or 401k money is alarming. The good news is if you take action, there are things that you can do to lower that tax liability. But if you do nothing, if you just sit there on that ticking tax time bomb, you're going to pay. The tax rates or the amount you're going to pay in taxes, like I said, is pretty alarming.
Mm-hmm. Do some people think that just by consulting with a CPA, they understand the tax implications of their retirement money?
Probably, and I hope they have a CPA that they trust. But what we found is there's a lot of really good CPAs but a lot of them are just kind of looking at what you're doing now. They're not looking forward. So we like to partner with the CPA so we can do the job looking forward to say, okay, let's do Roth conversions. Or especially if you're a farmer, if you have a lot of expense this year, a lot of deductions, well, let's fill that in with Roth conversions and potentially at a 0% tax rate. So farmers do have an advantage there, but you have to have a plan
Sure.
in order to get that done.
Great. Let's get a plan together. Use this phone number to call Stonebridge, 866-295-5146. Jeff is in the Kearney office, but all of the offices are fully manned and womaned, 866-295-5146.
As Americans, we strive for better. From a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Well, you can get your own score from Stonebridge. There's a very, I think all of these new additions to your toolbox are going to be very helpful to people, but StonebridgeRetirement.net. Now, this is going to measure your retirement readiness in a little
correct.
quiz, okay?
Yep.
And you'll be getting your retirement readiness score from this little quiz online.
Yeah, this quiz, it takes about, 5 to 7 minutes. So it takes a little bit longer than like if you ever gone to stonebridgetaxbill.com, that one's pretty quick. I mean, you put the information in there. As you can imagine, the retirement readiness quiz, it's a little bit longer because it's asking about all of the different areas of financial planning. It's asking about your healthcare plan, your legacy plan, all of those things to make sure. Because when you retire, all of those things need to be taken care of. And that's why we developed the retirement compass in the first place. But
Sure.
like I said, it's a good starting point to see where you're at. It'll give you a number at the end that tells you how ready you are for retirement. So, yeah, it's a good tool.
It says, nice to meet you, Jackie. This assessment aims to offer you insights into the various aspects of retirement planning, covering financial stability, healthcare, income sources, risk management, and more. It's cute. I think this will be really nice for people.
You'll have to go through it and see how ready you are, Jackie.
Yes, well, you'll see it on the other end, on your end. Go, oh, that's Jackie. Yes, yes.
And she is so ready.
She's so ready. Maybe she should stop working with you. No, just kidding.
You're stuck.
I think so too, gosh darn it.
Yeah.
Well, that's a really good one. And what do you think that, I don't know, this is going to accomplish for people? A non-confrontational way to deal with pre-retirement planning?
Yeah, and I think, a lot of people that I've talked to that, they say, I've listened to your show for 8 years and I'm just finally calling because I was always afraid of what I was going to find out.
Oh,
It's like having a health issue and there's something, but you're afraid to go to the doctor because you're afraid what it is. And then you go in and it was something simple that they give you prescription XYZ and now you're fixed. Same thing here, but it gives you kind of a low barrier of entry way to just dip your toe in and see, okay, I've got some stuff set up, or maybe I don't have anything set up. How ready am I for retirement? And it'll give you the answer. And for a lot of people, there are things that need to be addressed. That's to be expected. But the good news is a lot of those things are pretty simple. And they're things that we work with on a daily basis, things that we talk about on the show on a weekly basis that aren't overly complicated. So that's what I think it is, and I hope that it is for those people that, have that fear of the unknown, where, we can expose those fears and address them with a simple quiz that'll take you 5 to 7 minutes.
Fun. And again, that one is StonebridgeRetirement.net. And to reach the team, if you'd like to have the centralized phone number that we have rigged up for the radio show here, It's 866-295-5146, 866-295-5146. And maybe it's just a matter of shifting some of your thought processes, and you can get your rewirement. See what I did there? Rewiring your brain for retirement.
That's clever.
Thank you. We could get your rewirement done with some financial and tax strategies that won't become burdensome or that won't feel burdensome. One of those, in the last couple segments, we were talking about the 401k and IRA, Jeff.
Yeah.
And this becoming a burden maybe to the next generation or to yourself with those required minimum distributions. What if people are living on the money, they've given the kids the money they already want to, and there's this great big lump of money in that account? They can disperse some of this to charity.
Yeah. Well, and if charity is important to you, that's great. But you definitely want to have a plan for that, because if you've got what we call non-qualified money, like money in the bank or in CDs or just a brokerage account, and you have IRA money and you have kids, the IRA you want to leave to charity because they won't pay tax on it. So that's a common mistake. Or naming the charity a beneficiary of the life insurance. We don't want to do that if we have IRA money, because your kids would get that death benefit tax-free. The charity gets it tax-free too, but they get the IRA tax-free, where your kids would have to pay tax on it. So another thing we were talking about on previous segments was, setting up your plan for long-term care and some of those things. But I want to talk about how important it is to have to use the retirement compass, because if you just went in and set up your healthcare plan and you said, that is my biggest fear, I've got $500,000 saved, I'm going to put $300,000 in this life insurance policy to make sure I'm covered for long-term care.
Okay.
But then you can't meet your income needs, or you can't invest money in a way that's going to allow you to be successful, or your legacy plan is messed up because you can't take the grandkids on a trip that you wanted to take them on. We have to make sure all of these plans work together, because in the end they do. They're going to work together one way or another, or against each other one way or another. So we need to make sure that all of those areas are covered. So we have your income plan that's taking care of you to make sure you don't run out of money. Then we have the investment plan that's going to help you cover inflation in the future, make sure your money's invested in a way that's helping, that first step, the income plan. The tax plan, let's pay as little tax as possible.
Sure.
The healthcare plan, making sure that we're protecting everything and that we have the right plan. And that doesn't mean you need to buy insurance. It means you need to have a plan. I just had a guy come in the Omaha office this last week, and he probably doesn't need long-term care. He can self-insure that. So I would rather him grow that money. Now he could defer that risk over to the insurance company if he wanted to, but it's not a need. He would be able to fund that. And then the legacy plan, how do we get everything that you work so hard for to the next generation? If you focus just on one of those areas, you're leaving yourself exposed on the others.
This is important. 866-295-5146. If you want to be seen in the Lincoln office, Omaha office, Kearney office, Grand Island office, or they can come to you, 866-295-5146. Let me have a follow-up question on that fellow that you were talking about. If the market showed signs of going down, would you still make that same recommendation to him to not leverage an insurance company for his long-term care because maybe his money isn't going to grow?
For him, probably, just because of the way he would be positioned. Now, it depends. There's some changes that we think he should make to take some risk off the table.
Oh, okay.
And he listens to our show, so if you're listening,
oh, great.
Sneak preview of our next appointment, I guess. But de-risking some of his portfolio, where if the market goes down 30%, he's not going to lose 50%. Putting him in a position where his money's still going to grow, but he has some protection there.
Well, that's good, because then we wouldn't want him holding the bag on, self-funding the long-term care if he's lost money.
Right.
And don't you agree that a lot of times wealthy folks would never consider self-funding because then that would affect the legacy plan?
In some cases.
Okay.
I mean, if you've got $10 million, even if the cost of long-term care is $150,000, I mean, that's 1.5%
Okay,
of your
I see.
portfolio.
Right.
So I mean, we're always concerned about that risk, but you could self-fund that. You're not going to deplete your assets to
I
pay
see.
for an extended care event.
I see.
But everybody's case is different. That $10 million individual might say, well, let's throw, $1 million in this to make sure that's covered, knowing that this is still going to grow. So we might say that depending on our risk tolerance. And at the end of the day, our clients are the CEO of their plan.
Sure.
We're the CFO. So they're going to tell us what they want and we're going to make it happen. But we're also going to point out the potential pitfalls in their plan of, okay, I know you don't want to buy long-term care insurance,
Right.
but here's the risk, sir. You go to a long-term care facility, you're leaving your wife exposed because you're going to spend all your assets. She's not going to have anything. She's going to live on Social Security. That's the case sometimes. So it does make sense to buy it. But we aren't long-term care insurance salesmen. It's a tool to fix a certain need, but not everybody needs that.
Surely.
It's case by case.
But everybody does need a plan so you can see
Yeah.
these things and have an objective point of view. So you
Right.
don't just hop online and say, I want to buy long-term care insurance, ask Dr. Google, or Dr. AI, and then you think, okay, this is a really good idea when it could be sapping your assets in another spot.
Well, I should take a step back because that individual that I was talking about, he still needs a plan.
Sure.
He still has to have a plan for that because even if you're self-funding it, communicating, he's not going to be the one making that decision. His wife is younger, so she probably will, or it could be their kids. So telling the kids what you want to happen, what we're talking about with long-term care insurance, that's just the funding mechanism. How are we paying for it?
All right.
That isn't the plan. The plan is, here's what I want to happen. I want to stay at home as long as I can. I'm moving in with my oldest son. Well, he needs to know that's your plan. If that is your plan. Maybe you have a daughter that's a nurse or something like that, and you're expecting that they're going to be able to take care of you. That could be a plan, but you have to also remember that may cost that daughter her job because now
Right.
you're the job.
Loss of income.
Yeah. So again, long-term care insurance is not the plan.
Okay.
Self-funding is not the plan. That's how we're paying for the plan.
Very good.
Very different.
Very different. And I'm glad that you clarified that. 866-295-5146. Call Stonebridge. Stonebridge Wealth Systems. 866-295-5146.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
Well, some scenarios for the team at Stonebridge Wealth Systems on this part of our show, Retirement Compass Radio Show with Stonebridge, 866-295-5146, 866-295-5146. And good news, Stonebridge Wealth Systems is on YouTube. All you have to do is go to YouTube and then type in Stonebridge Wealth Systems, and then please like the page. We would appreciate that very much. And you can watch our shows there in podcast form. And we'd love to have you, watching us every week or listening every week, of course. And I know a lot of people do, don't they? They listen every week. And then when they have a need, they get in touch.
Mm-hmm. They do.
Well, let's go into a couple of needs, scenarios for the folk. Somebody who is turning 73, Jeff, facing their first RMD. We talk about this a lot, required minimum distribution. This is going to bump people into a higher tax bracket without some thorough planning. What if they don't need the income right now, but they want to avoid unnecessary taxes? What is that strategy even at age 73?
Mm-hmm. Yeah, so it's a good question. So let's start with just what a required minimum distribution is.
Oh, please.
I think most of our listeners know what that is, but just in case. So what that is if you put money in an IRA or a traditional 401k, something that's tax deferred, where you deducted it when you put it in and it's grown over the years, at some point, which for this individual, 73, if you were born in 1960 or later, it's at age 75. But for this individual, age 73, the government is saying you can't defer this any longer. It's time to start taking money out. It'll still be tax deferred, but you have to start drawing on this. It's time to start paying tax on this money. So what happens is, let's say you've been living on Social Security, and you have all the income that you need. Maybe you have a pension. Then you get to 73 and you get this letter in the mail early in the year from, Schwab or Fidelity, whoever has your money. And it says you have to take out $50,000 this year, your required distribution. So you're going to pay income tax on that if you just take it out, which that could cause 85% of your Social Security to become taxable. There's a lot of other taxes that could come into play because of this distribution. So it's really important that you have a plan for this. Another thing that you could do, instead of taking that, say you don't need the money, and let's say you give money to charity, you can have this, it's called a qualified charitable distribution. You can have that money go directly to the charity instead of coming to you. It satisfies that required distribution, and you don't have to pay tax on it. So that's another way to do that. So when you get your most people are, I think it's like 90% of the people are taking a standard deduction, meaning they're not itemizing. So you get to do both. You get to take the standard deduction of whatever it is for you, and then also essentially get to deduct this required distribution.
So this is some good planning and some good strategy. So it's not too late, even if you already are 73. Because didn't you say it measured the year before or the year?
Yeah, it's based on the December 31st value the year prior.
Okay.
And then we have the IRS gives us, it's called a uniform life table, individual uniform life table, where it's going to tell us at age 73, you divide the December 31st value by this number, and that's how much you have to take out. So every year that amount's going to go up. Hopefully your account balance is also going to go up. So yeah, you'll have to take out more as you get older. But this is why, we talk so much about tax planning, because of you're probably not just paying tax on that distribution. It's probably causing tax on other dollars. So it's really important, even if you're 73 now, there still are probably some things that you could do to help yourself in the future. If you're not 73, I would encourage you to take action now, because that day is going to come when the government says you can't defer any longer. You have to start taking money out. Go to stonebridgetaxbill.com. That'll give you an idea of what you're looking at when you're paying tax on those assets over the rest of your life.
Okay, stonebridgetaxbill.com or 866-295-5146. 866-295-5146. All right, folks living on Social Security, of course, we're all going to be saying that sometime. Also a mix of taxable and tax-deferred accounts. But what if you are not sure which account you should be drawing from? Now, this is obviously without a plan, right? So what's the best order to pull income from to help reduce taxes?
That's a really good question. And this is something that has to be customized for each individual, because it depends on how much your Social Security is. It depends on how much you need. But the way we would structure this is we would want to take as much out of the tax deferred account as we can, while keeping you in the lowest tax bracket that we can. So we'd take out that tax deferred first up to a certain limit. Again, that's going to be different for everyone, because it depends on how much your Social Security is. We talk about, for Social Security taxation, there's a calculation called provisional income, which this calculation is just to determine how much tax you'll pay on your Social Security. So the way that's calculated is they take half of your Social Security and then all of your other income. They add all of that up. If that's over certain numbers, there's some, if you're married, it's over 32, but less than 44, 50 cents of every dollar is taxable. If it's over 44,000, 85% is taxable. So we want to keep you below that 32 with half of your Social Security and all your other income, or not over the 44. So there's a lot that goes into that, but that's why, again, we developed the Retirement Compass. And this time of year, we're doing tax reviews. I sent all of my clients an email with a secure link that they can drop their tax return in, and I can look before the year ends to see, is there anything we need to do different? Could we put a little bit, if you're working part-time, could we put a little bit of money in the Roth IRA and you get the saver's tax credit so it wipes out all of the taxable income? Can we move money from the IRA to the Roth IRA before the end of the year at a low tax rate? There's a lot of different things that we can do before the end of the year here.
Very good. So get on the list of new clients for Stonebridge. At least have the inquiry. There's no cost and no obligation to sit down with them. Stonebridge Wealth Systems, 866-295-5146. But that sounds like a really comforting idea, is to have somebody looking at your tax planning in addition to your financial plan for your retirement, for the upcoming year. And this does speak of strategy, not exactly tax preparation, just to be clear.
Yeah.
But if you'd like to go and have a look at how this is going to affect you, stonebridgetaxbill.com. That's a really good landing page and very informative, Jeff.
Mm-hmm.
All right. Yes. Here's another scenario. I've got a large IRA and no long-term care insurance. People could be worried about future health care costs, but considering setting aside a portion in a health savings account or using a qualified charitable distribution to reduce the tax bill. But
yeah. So
how do people think about this big health care expense later in life?
Yeah. I mean, I feel like I'm beating a dead horse here, but this is why we have the Retirement Compass. All of these things need to be addressed. One thing with the HSA, your health savings account, those are really, really good tools to have when you retire, because a lot of times people won't buy dental and vision insurance when they retire. They go on Medicare, and then you pay out of pocket for those other, your dental. When you go to the dentist to get your cleaning, you just pay out of pocket, or go to the eye doctor, you just pay out of pocket. You can buy insurance, but a lot of times I don't think it makes sense. But you just have to crunch the numbers for you.
Okay.
So the HSA, where that's helpful when you retire, is to cover some of those expenses.
Yes.
Whether it's prescriptions, your glasses, your dental work, you can use the HSA to cover all of that stuff. With that being said, Scott in our office, one of my partners, is his uncle passed away and had $72,000 in an HSA. He was single, no children, and had some pretty significant healthcare expenses at the end there, but didn't have anybody to run that through the HSA. So essentially what happened was that was froze when he died, and all of that you didn't use for your healthcare costs is now taxable.
Oh.
So when it comes out, it's going to be taxable to your beneficiaries. So that was kind of a bummer. So they are a really good thing. It's nice to have that. I'm going to be fully funding my HSA every year. But you have to know the other side of it too. So don't think, I don't want to use this money because I'm going to just let it grow. Especially if you're retired and have a bunch, if you talk to people that have, $200,000 in their HSA and they're not trying to use that money up, you need to use that for your healthcare expenses, because if you die with that in there, it's going to be taxable to your beneficiaries.
Could you use that for long-term care?
You could. Yep. You can pay for those expenses out of there as well. Yep.
Now that would be a beautiful thing, wouldn't it? Then you could self-pay out of your HSA.
Right. Yeah.
It'd be a good idea to have a medical power of attorney in case you were not able to make these kinds of signature decisions.
Yeah. And I mean, that's the healthcare, durable power of attorney, financial power of attorney. Those are important to have anyway as part of your legacy plan, because the day will come when you can't make those decisions. So you need to have somebody in your corner and make sure they know that that's the role that you're giving them. It's not a surprise. But otherwise, they have to. It's kind of a mess going through the court to get those things set up in an emergency format, I guess.
Yes, it can be a real mess. All right. I'm so glad that we talked about that, HSA. 866-295-5146, 866-295-5146, and give Scott our best on that untangling that web there of financial difficulty. It's best to get a plan for all of this.
Yeah.
All right. One more time on the number for Stonebridge Well Systems, 866-295-5146. Jeff, I'll see you next week.
Sounds good. Thank you.